Hello and welcome to the Canaccord Coffee Break podcast. I'm Tom Willis. I work with our regular host, Jane Parry. Over the next 2 weeks, I'll be stepping in as co-host while Jane is away to guide you through our usual deep dive into what's happening in the markets. Today, I'm pleased to be joined by Tom Hibbert, Chief Investment Strategist in our Chief Investment Office.
Hi, Tom. Pleasure to have you on the podcast today.
Yeah,
There's a lot of Toms in the industry.
There are a lot of Toms in the industry, and particularly at Canaccord. So I'm added to the list.
You know, it's your first time co-hosting the podcast, so yeah, as I say, pleasure to have you on. But we usually say at the start, any new guests, what's your coffee preference?
So I do enjoy coffee. I'm not a coffee connoisseur, so normally when I'm abroad, I might have a nice espresso. But when I'm in the office, it's instant coffee, black, no milk, and very, very strong.
Fair enough. You know, I quite like an instant coffee sometimes as well. There's nothing wrong with that.
A bit of a guilty pleasure.
Yeah, absolutely.
So each week, our podcast is based on Tom's weekly markets review, and it's here to cut through the noise, explain markets in simple and clear terms, help you feel informed and confident. So hit follow on Spotify, Apple, or your platform of choice so you never miss an episode. Welcome to this week's Canaccord Coffee Break. Grab your coffee and let's start.
Let's get into it.
So last week on the podcast, we discussed whether AI was breaking the software business model. And this week feels like part 2 to that story. The disruption narrative has seemed to move on from impacting software companies. Now financial services such as banks, insurance companies, and wealth managers were suddenly in the firing line. So Tom, what's triggered this shift in the disruption to these financial services companies?
Yeah, so I mean, if you look on the surface last week, global equity markets didn't move. But under the bonnet, you've got quite a serious rotation happening. And you've asked what's triggered it. It's tended to be sort of new AI tools. So last week, it was enterprise software. This week, it's broadened out across sectors, but particularly concentrated within financial services. And the main trigger was the launch of new AI tools from Altruist and Insurify, which showed how AI could automate parts of the financial services industry. So things like insurance underwriting and research, tax planning, and within wealth management, things like that. You know, and markets at the moment, they're very sensitive to AI disruption fears. We've got this AI scare trade, people are calling it at the moment. So the mentality at the moment is shoot first, ask questions later. So within financial services firms, you know, there's growing fears that AI could disrupt operating models and compress margins across the industry. And it's very similar to what we saw last week within software. Markets are trying to figure out which industries, broadly speaking, will be threatened by AI. And at the moment, it seems like it's, you know, a whole swathe of white-collar jobs that are no longer safe. And AI is getting better and better at an incredible rate.
So you mentioned that the AI threat was similar to how software has been threatened the previous week. How immediate do you think is this threat?
Yeah, I think it's difficult to say, really, because obviously this is a new technology and the innovation curve is very steep and AI tools are getting better and better all the time. I think I would say if you look through history, when you have new technology, it's tended to improve productivity and enhance the offerings of these companies rather than sort of destroy entire industries. So I'm careful to be too pessimistic and I don't want to give a timeline, but it's difficult to say. But I think many of these businesses will be able to use and become more efficient on the back of enhanced tools effectively.
By Thursday, the disruption seemed to broaden out.
Yeah, it did. So the move spread to major banks sort of midweek and the sell-off within sort of growth sectors and financial services accelerated midweek. So the global financial services sector ended the week down about 2.5%. In the US, it was closer to a 5% fall. So there was dispersion within the sector, but the key point is that it was a sort of thematic move. And as I say, you know, it was a shoot first, ask questions later mentality. So a broad sector-wide sell-off. Yeah, and as I said, we often see this early in technological shifts. Investors first price disruption aggressively, and then over time, they start to differentiate between companies that either adopt the technology and those that fall behind. So I expect winners and losers to emerge from what is at the moment a sector-wide sell-off and sector-wide scare.
We mentioned about economic moats on the last podcast and the protections that companies have against disruption. Is that the case here? Do you think some of these financial services companies that have been impacted have good moats?
Yeah, I do. I think when it comes to things like wealth management, such a big part of that is about a human relationship. You know, they've a lot of these businesses already have significant scale. They've got really strong client relationships, regulatory infrastructure. I think AI can enhance productivity within those frameworks, and people still value human decision making and client relationships. So I think there are economic moats here that will support the sort of future of a lot of these financial services firms. But obviously there is a lot of uncertainty around it at the moment.
And you mentioned there about winners in the AI story, and some of the winners over the past few years, such as NVIDIA, Apple, Microsoft, also came under pressure.
The Magnificent Seven.
The Magnificent Seven, yeah. These stocks have had a fantastic run in recent years, but is it fair to say that the excitement around them has fizzled out a bit, and why is that?
Yeah, it is, and they're down year to date. So the key question is around their capital expenditures, their investment. So the Magnificent Seven projected to spend about $650 billion in 2026 across the largest tech firms. I think that's actually across the 4 largest tech firms. And that's primarily going into infrastructure rather than sort of shiny new products. And that means data centers, AI chips, networking equipment, energy contracts. Investors are becoming cautious because this level of CapEx is massive relative to these companies' free cash flow. It's absorbing their free cash flow effectively. And that raises questions about where they're going to get capital funding from. Are they going to have to tap the bond markets, which they're already doing to a large extent? And even whether companies sort of reduce their share buybacks, take on more debt, as I say, or just accept lower near-term profitability. And I think that's the key concern for investors. You know, there's a realization that this is effectively a land grab, an AI arms race, where companies want to capture as much market share as possible. If they have cash, they're going to spend it to try and capture that market share. There's not even an expectation that it's going to lead to profitability in the near term. And, you know, obviously that's a risk. It's a strategy, and people are questioning whether there are comparisons with excessive investment during the tech bubble, or whether this really is a worthwhile endeavor for these businesses.
So as the AI disruption impacts companies and they perform not as amazing as they have done, which parts of the market seem to benefit from these shocks, this disruption?
Yeah, so I mean, all of this sounds pretty negative, but actual global equity markets were flat last week. And that is because investors weren't really selling equities. They were rotating within their equity portfolios. So you have a clear defensive rotation within equity markets. Things like utilities up 5% last week. Materials up 3%. And you did have, I say, people aren't selling equities. There's probably a slight downward bias within equity markets. So you've also got things like government bonds performing well, high quality investment grade credit is outperforming more risky high yield credit. So it's I think an aspect of this is, yes, there's a defensive shift, but it's not just a safe haven trade. It's also this shift towards what people refer to as the old economy. So those old economy sectors, things like materials, energy, and utilities, benefit directly from AI infrastructure build out. So AI needs power, it needs materials, industrial capacity. So winners are sort of extending now beyond tech, and as concerns arising about tech. So we've got this quite aggressive rotation within equity markets. And I suppose I would say the focus is on the old economy supply chain aspects of AI that are now doing well. And that has been the trend for the year so far.
Thank you, Tom. It's a pleasure to speak to you as always. If I can just sum up what's in my Canaccord takeaway coffee cup. Markets are repricing the AI risk. Software was disrupted last week. It's financial services this week. Even some of the biggest leaders in tech and AI are being questioned on their spending and returns. money has been flowing to defensive and what we call the old economy sectors. So the theme, the AI narrative, is going from pure buzzing excitement to scrutiny, and makes me think that balance and diversification matter more than ever, if you agree, Tom.
Yeah, totally. That's bang on, Tom.
Thank you. Thank you so much again, Tom, for joining me. It is a pleasure. Thanks for listening. Hit follow so you never miss an episode. Share your thoughts and feedback at coffeebreak@canaccord.com. And as always, stay invested, stay balanced, and stay on your toes.
Thanks for listening, everyone.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.